In this video, I will share my thoughts on all things crypto, or a better term that I like to use is distributed ledger technology. I touched on this a bit in my video on wealth management, but now I will go deeper into Bitcoin, other distributed ledger projects that I find interesting, DeFi, CeFi, and more. I feel compelled to do this video now because of the whole Celsius network debacle that's going on. In my earlier video on wealth management, I spoke highly of Celsius, and I made the following claims. I said that Celsius is way better than its competitors. I said it offers the best interest rates, has a great CEO, is most transparent, has the best people, best track record, most experience, best security, most compliance, and they have an exciting roadmap. Saying these words now just makes me want to throw up. Turns out that I couldn't have been more wrong. I was duped. The exact opposite is true. The CEO, Alex Mashinsky, he's actually been straight up lying this whole time, engaging in deceptive practices, engaging in Ponzi-like behavior, and being very irresponsible with managing client assets. It turns out that Celsius was just a very poorly run business. In retrospect, it is now clear that there were lots of red flags. Unfortunately, I didn't take them seriously, and now, I'm paying the price. Celsius Network has filed Chapter 11 bankruptcy, and it is looking likely that depositors will not get their crypto assets back. Celsius has a $3 billion hole in their balance sheet, and it looks like they might run out of cash by, as early as October. So practically nobody trusts Celsius anymore, and they've completely ruined their brand. Celsius Network, as a company, they're toast. The best hope for depositors now is to receive a fraction of their crypto assets back and maybe some equity in a new company proportional to the funds that they lost. So in my mind, I've pretty much just written off any coins I had on Celsius as a complete loss. Suffice it to say, this whole experience has moved me firmly in the camp of not your keys, not your coins. Unfortunately, I had to learn this lesson the hard way. I no longer trust centralized finance or CEFI with my private keys. All CEFI platforms where you give up your private keys in exchange for the promise of yield, such as, Nexo, BlockFi, Crypto.com, Celsius, I see them all as problematic. I still believe DeFi or decentralized finance has a lot of potential. DeFi allows you to earn yield on your assets by providing similar financial services that Wall Street offers, but it uses smart contracts instead of central entities, and there are less associated costs. And you still hold on to your private keys. So DeFi is still fairly new, and there have been a lot of hacks with various DeFi protocols, so there's still a lot of risk with it. But there's also a lot of reward if you can do it carefully. So as DeFi matures, the risk should reduce also. Right now, it is wise to only put a small percentage of your portfolio into any DeFi protocol. And ultimately, it is best to keep the majority of your crypto assets on a hardware wallet, brain wallet, paper wallet, or something that only you have complete control over. Right now, I am exploring DeFi by doing liquid staking with Stater Labs. I am providing liquidity in SaucerSwap via the HBAR, HBAR-X, and HBAR USDC liquidity pools. And I'm also staking the LP tokens on SaucerSwap. I've also used Uniswap in the past to swap tokens. I will now share some thoughts on distributed ledger technology projects that I find interesting. The main reason that distributed ledgers are used at all is because we don't trust each other. If there's already trust in a given situation, then there really is no need for distributed ledgers. Regular databases usually work better. You should only have a distributed ledger if there's no other way to do it, because distributed ledgers are such a cumbersome and expensive solution. Some applications where distributed ledger technology can be beneficial include money, property ownership, contracts, financial services, data oracles, gaming, privacy, governance, identity, stablecoins, and many other use cases. I believe that the biggest, most important application for distributed ledger technology is money. And I believe that the best form of money is Bitcoin. I consider myself a Bitcoin monetary maximalist. This means that I believe that Bitcoin has the best monetary qualities, divisibility, durability, recognizability, portability, verifiability, and scarcity. Bitcoin is optimized for being the best money. I don't really see a competitor to Bitcoin at this time. Therefore, I believe that Bitcoin has the best chance of becoming the world reserve currency or world reserve asset. Bitcoin is sound, hard, neutral, and simple. The code is only a couple hundred lines. Bitcoin has an immaculate conception. It is more in line with the principles of Austrian economics. It has been a great store of value over time. It has a substantial network effect. It is a great monetary debasement hedge, and it is insurance against the precarious modern financial system. The Bitcoin monetary network, especially with the development of the Lightning Network, has already demonstrated its superiority over legacy international remittance systems like Western Union and others. So while I believe that Bitcoin is a clear winner in the money category, I don't really think it is good for anything else. In fact, I believe that in order for something to be good money, it cannot be good for anything else. If a distributed ledger has some other use case, then that use case undermines its use case as a money. So all other non-money distributed ledger applications are probably better served by other non-Bitcoin projects. And the best non-Bitcoin distributed ledger project that I see is Hedera. I believe that Hedera really will become the dominant network that will form the main trust layer of the internet. Hedera is owned and governed by the world's leading organizations, Google, Boeing, IBM, LG, and a bunch of others. They have 26 members now, and soon they will have 39 world-class, highly reputable organizations that are decentralized across different industries, across different geographies, and they are term limited. I believe that this governance model is the most resistant to collusion and coercion, which is the ultimate measure of decentralization. Having a strong governance like this also allows the network to quickly adapt as the world changes. Hedera is ABFT, or Asynchronous Byzantine Fault Tolerance, which is the highest grade of security possible for a distributed ledger. I'm not aware of other crypto projects that have this level of security. Not only does Hedera have the cheapest transaction costs, with an average transaction cost of 1/1000th of a penny, but since the transaction costs are priced in dollars, they are predictable. So this is extremely important for enterprises who need to do financial forecasting. Hedera can scale to meet pretty much any need. It is currently throttled to about 10,000 transactions per second, but it can go to about 100,000 transactions per second on a single shard. And with sharding, it can practically do unlimited transactions per second. Hedera is among the fastest distributed ledger projects available. It has transaction confirmations in just 3 to 5 seconds with finality. Hedera has fair ordering. Hedera has the lowest energy consumption per transaction of any major distributed ledger. And Hedera has, a $5 billion war chest, which is being used to develop the Hedera ecosystem. So I believe that Hedera will become the go-to layer 1 platform for smart contracts, NFTs, tokenization of real-world valuable things like equities, real estate, fine art, etc., DeFi, governance, identity, micropayments, and other applications. Hedera was specifically designed and optimized for enterprises from the ground up. Business enterprises have some of the largest, most impactful use cases in the world, and perhaps one of the more important use cases that distributed ledgers could help with is interorganizational exchange of value. This is especially crucial for businesses that do logistics and financing of trade. There are many real-world businesses that are currently using Hedera. On the Hedera website, Hedera highlights, I think, like 39 businesses or so that have applications that use Hedera. But there are many more than this. Some of the current bigger players using Hedera include Atma.io, which is a company that tracks over 22 billion items across, the product's life. AdsDAX, which is an advertising company that has executed almost 2 billion crypto payments. Drop, which is a micropayments company that has partnerships with Shopify and WordPress. And the Coupon Bureau, which processes coupons for most major companies like Target and General Mills. And there are many more applications and projects in the pipeline which could be massive. Proof of concepts have been completed for CBDCs, international remittances between banks, digital workflows, micropayments, and there are many other big projects in the works. As with anything, though, there are still risks with Hedera. Hedera is not a slam dunk automatic winner just yet. There are still some potential downsides to Hedera that could make it fail. Perhaps the biggest risk is that Hedera is not technically really decentralized right now, at least not in the traditional sense. Currently, only governing council members can run a consensus node. Hedera has plans to allow anyone to run a consensus node in the future, but there are no firm timelines on this, and there are no clear defined milestones for this transition yet. Ultimately, the transition will depend on the judgment of the Hedera Governing Council, and they will consider things like network adoption, network performance, and the price of HBAR. There is potential that Hedera may never become a fully public, permissionless, decentralized network, and it will just forever be a glorified corporate shared database, which may not bode well for large-scale adoption. Another potential risk is that the HBAR tokenomics right now may not be that great. You might not get rich quick buying HBAR. It is definitely a long-term play. Hedera has been and is currently dumping a lot of HBARs on the market to pay for its ecosystem development. In the long run, though, if Hedera does reach mass adoption, the price of HBAR should be much higher than it is today because HBAR holders will get a small cut of all the fees paid to the network. So the more transactions on the network, the more valuable HBAR should be. Another potential risk is that regulators officially label HBAR as a security. They impose burdensome regulations on it, and they crack down on the distribution and use of HBAR. Biden's executive order on cryptocurrencies aims to ensure America remains the global leader for technological innovation for years to come. So I don't expect the regulations to be overly burdensome. Also, Hedera has already been operating with the assumption that HBAR is a security. So even if regulators officially claim that HBAR is a security, that should not dramatically impact the Hedera operation. Another potential risk is that another technology or network could come along with better performance, better security, better governance, etc., and make Hedera obsolete. I personally find this to be unlikely anytime soon, but I guess that is always a possibility. The last potential risk I will mention is that Hedera secures the network through proof of stake, which comes with its own set of issues. For one, there's nothing in the real world that is securing the network. For Bitcoin, electricity and miners are securing the network. For Chia, hard drive space is securing the network. There is some connection to the real world there. With proof of stake, the network is being secured by something purely virtual. Proof of stake is more complicated, and there are just inherently more attack vectors. In computer science, you cannot fundamentally prove that a given software program will always hold. There is such a large combination of input and processing and output that you cannot test it comprehensively. So the way you test software is that you test it long enough and you say, that's good enough. And the last potential downside of proof of stake systems, at least that I will mention here, is that they have a tendency to become more centralized over time, simply due to the fact that capital centralizes. Those who currently have HBAR will continue to get more of the HBAR through staking. So if a bad actor owns more than 1/3 of the stake, which means they own 1/3 of all the HBAR, they could do some malicious things on the network. This is true for all distributed ledger networks. If anyone gets more than 1/3 of the stake, or more than 1/3 of the hash power, or whatever that is being used to secure the network, they could do some malicious things on the network. Hedera is not worried about this now because the Hedera Governing Council owns most of the HBAR. So as long as you trust the Governing Council, then this risk is not a concern. However, the Governing Council plans to distribute their treasury over time, and they ultimately do not plan to keep most of the HBARs. If HBARs cannot be distributed widely enough, and if the value of HBARs is not high enough, the Hedera network may need to keep most of the HBARs and remain more centralized, or they might be vulnerable to a 1/3 attack. Personally, I'm not so worried about Hedera becoming overly centralized for two main reasons. The first reason is that I don't think it will actually happen. I see Hedera more like a startup or a company, and I see HBARs similar to shares in a company. As companies grow, like Amazon, the shares tend to spread out to different entities over time. The biggest owner of Amazon shares now is the Vanguard Group, and they only have 6.4% of all the shares. I believe Hedera will follow a similar path of share distribution. The second reason is that Hedera is not trying to be money. Hedera is not competing against governments. In fact, Hedera aims to be compliant with all government regulations. So even if government regulatory capture happened, that may not be such a bad thing for Hedera. Centralization of a coin is more of a problem if you are trying to be money and if you are trying to compete with governments. The next distributed ledger project that I would like to comment on is Ethereum. I'm not actually a huge fan of Ethereum. I think the main problem with Ethereum is that it is trying to be both money and the world computer. I see these two aims as mutually exclusive. You can either be a good money or you can have high utility like a world computer or network fuel or something. But you cannot do both. Any utility that a coin has outside of being money must necessarily hamper its use as money. Ethereum is currently transitioning from proof of work to proof of stake. I believe that this is a killer blow for the Ethereum as money use case. We already see that the staked ETH is currently very centralized with only 11 providers controlling almost 69% of all the staked ETH. And there's one provider, Lido, that owns almost 32% of all the staked ETH. And it is likely that this centralization will only get worse because staking ETH is complex. To stake ETH yourself, you need to have 32 ETH, which is pretty expensive, and you need to have a certain degree of technical chops that most people simply do not have. Most people will simply allow large entities to stake their coins for them, and staked ETH will continue to centralize. Convenience always wins. Also, if an ETF gets approved, that will further centralize the staked ETH. Ethereum is already captured by US regulators. Large regulated entities who stake ETH must comply with regulators, and the regulators are forcing these large entities to interfere with Ethereum at the protocol level. The recent news of OFAC, or the Office of Foreign Assets Control, sanctioning Tornado Cash is proof of this. If regulators like OFAC tell these large entities to censor an ETH address or an ETH transaction, they must do it, or they risk losing their government licenses. So these large entities will do whatever the government wants them to do. In essence, ETH is becoming a state-controlled coin. Government will completely control the large regulated entities that are the largest stakers on Ethereum, which means that the government, in essence, will control the protocol. This totally messes up its use case as money. Ethereum is not designed to be able to withstand nation-state level attacks. If OFAC or some other regulator really wanted to block applications on Ethereum, like DeFi, they could. On top of all this, Ethereum had a pre-mine or pre-sale. It has a history of changing in fundamental ways, like the DAO hack, for example. It may be considered a security, and it is very complex. So none of this makes it a good form of money. Ethereum is also not a good world computer. So, there are so many other projects that have better performance than Ethereum on, pretty much all relevant measures. Transactions per second, speed, security, energy consumption, etc. In addition, Ethereum accumulated a lot of technical debt over all these years, and it is slow to adapt. So it is only a matter of time until other platforms have all the same features that Ethereum has, and more. While Ethereum has benefited from a first mover advantage, and the network effects that come from that, for example, they have the most developers right now, there are tools being built that will make it very easy for Ethereum projects to switch from Ethereum to other better layer 1 distributed ledger platforms. Projects will naturally gravitate towards platforms that have the lowest cost, best security, most reliability, best governance, lowest energy consumption, etc. So Ethereum is kind of the worst of both worlds. It is bad at being money, and it is bad at being the world computer. Another distributed ledger project that I find interesting is ChainLink. I admit that I haven't looked deeply into ChainLink, but here are some things that I do know about it. one, for smart contracts to be really valuable and reach mass adoption, there needs to be a decentralized way to get real world data into distributed ledgers. ChainLink is the clear winner at doing this through their decentralized Oracle network. Another thing is that ChainLink Labs is a Hedera Governing Council member. And the last thing about ChainLink is that, I get good vibes when I hear its founder, Sergey Nazarov, speak. Another distributed ledger project I want to say something about is Chia. Chia seems to be the most decentralized blockchain in the sense that the network has hundreds of thousands of full nodes. The founder of Chia, Bram Cohen, he has some major credentials. He invented BitTorrent, and he may have even been roommates with Satoshi Nakamoto himself. I haven't looked into Chia in great detail, but I have a friend who is way smarter than me, and he's a total computer geek, and he thinks that Chia is the best distributed ledger project right now. So he actually convinced me to start farming Chia. I'm mostly interested in this project because of my friend's conviction in it. The last distributed ledger project that I want to call out is Monero. I personally haven't looked deeply into Monero, but I hear that Monero is the best privacy coin out there. I like the idea of privacy coins, and I think that they have a good use case. There are even good arguments that Monero could be a better form of money than Bitcoin. Right now, though, I am not investing in any privacy coins. Most people don't care about privacy, and I don't see big institutions buying privacy coins because I think governments will likely try to ban them or at least make them difficult to use. Therefore, I have a hard time seeing privacy coins reach mass adoption. If Monero cannot attract retail adoption, I don't see how it will gain institutional adoption. And if it cannot gain institutional adoption, I don't see how it will gain sovereign adoption. And if it doesn't gain sovereign adoption, I don't see how it becomes a world reserve currency or asset. Now, I will share some final thoughts about how I look at distributed ledger projects in general. There are thousands of distributed ledger projects out there, and I have not seriously looked into most of them. I'm not even sure that's even possible. So some things that I do is, I tend to ignore projects that have a small market cap. Those are too far out on the risk curve for me. I'm not into gaming projects or meme coins like Dogecoin or Shiba Inu, so I don't have much to say on those. Algorithmic stablecoins have proven to be unreliable, especially in crypto's infancy stage. So stablecoins from centralized regulated companies like USDC and Circle are probably the best ones to use at this point. I try to follow smart, well-informed, good-hearted people on Twitter. And when I hear people I respect talk about a particular crypto project, I tend to pay more attention to those. Finally, my strategy for investing in a distributed ledger project is similar to my overall investment strategy. I like to invest in clear winners in a given category. And I like to invest in projects that I believe can really make the world a better place. For example, I own Tesla stock because they're clearly winning in the EV space. Plus they have huge potential in AI, autonomy, energy, robotics, and other areas. And I own Apple stock because they are the clear winner in the cell phone space. Plus they have huge potential in health technology and a lot of other areas. So I apply this same strategy to distributed ledger projects. Bitcoin is the clear winner in the money category, and I think it could be a huge improvement over the current corrupt monetary system. Hedera is the clear winner in the enterprise adoption category, and I believe it will become the de facto smart contract, NFT, token, DeFi platform, and I believe it really will become the trust layer of the internet. And ChainLink is the clear winner in the decentralized Oracle category, and I believe it will enable real-world data to be used in trust-minimized applications. Therefore, these are the projects that I like to invest in. There may be a handful of other distributed ledger projects that might amount to something, but I don't know what those will be. I believe most other distributed ledger projects, including Ethereum, will eventually just wither away. So that about sums up my thoughts on all things crypto. Thanks for listening, and take care.